Great. So thank you so much to the organizers for including us on the program. This is joint work with Matteo Maggiori and Brent Neiman. The starting observation for this paper is the well-known fact that economic activity is increasingly funded by foreign investors. So if you go back to as recently as the 1970s, little to no of U.S. corporate debt was, say, owned by foreign investors, whereas recently it's been well over 20%. Yet as the increasing importance of foreign investment for funding economic activity has increased, what we haven't seen is a real improvement in the quality of data, particularly at the micro level, to measure how differently foreign capital is allocated versus domestic capital. Instead, what we've seen is quite a bit of improvements in data sets that look at only cross-border flows, but it's very difficult to see essentially how different are foreigners from domestic investors. We kind of fill that gap in the literature by bringing to bear a new data set combining $27 trillion of position-level data from a global mutual fund data company, Morningstar. And we use that data to essentially document the importance of the currency of denomination of assets as a determinant of investors' portfolios. Now, we have three kind of main findings in the paper. First is that investors all around the world display strong home currency bias. And so in particular, investors all around the world are overwhelmingly investing in currencies, in fixed income that's denominated in their own local currency. And in particular, knowing the currency of denomination of a bond is going to tell you more about who is likely to own it than the nationality of the country that issued it. So this is the sense in which, in an explanatory sense, knowing the currency of an asset is going to tell you more than the nationality of the issuer, to saying whose portfolio it's going to show up in. Now, why would you care about this home currency bias? So if every firm borrowed in every currency, you could have investors sort into buying the particular bond in their own currency, and the debt of every firm would show up in every investor's portfolio. But in fact, what we see is that only some firms are going to borrow in foreign currency. And so in particular, some firms are going to borrow in foreign currency. These are going to be the larger firms, and they're going to essentially be the ones borrowing from foreign investors. You're going to have the relatively smaller firms on average only borrowing in their own local currency. And what we're going to show is that this means that they are essentially only receiving debt financing from their domestic investors. And so in some sense, we think that this is highlighting essentially why you should care about who's the issuer of the international currency, because there's going to be one big exception to this pattern, the US dollar. Foreign investors are overwhelmingly willing to hold debt denominated in US dollars. And so what does this mean for American firms? Well, if you're a Canadian firm and you essentially want to tap global capital markets and get money from foreign investors, you have to borrow in a currency other than the Canadian dollar. I'm going to show you some evidence that it looks like there's a fixed cost in terms of doing that. If you're an American firm, you can do what you were doing otherwise. You can issue your dollar bond, and you'll already be borrowing from foreigners. So essentially, why do you care? What's the benefit of being the international currency? You're essentially opening the capital account for firms that are borrowing only in the local currency. Now, the final thing we're going to show is that this characteristic is not necessarily as stable as you would think. Just since 2008, we're going to show that the use of international currencies has changed dramatically, and in particular, the euro has begun to lose its use of an international currency to the dollar. So I'm going to briefly describe our data set, then I'm going to jump into our findings on home currency bias, show how this affects the allocation of capital across firms, and then show you some how this use has changed over time. So let me go very quickly through the data. So basically, Morningstar is a commercial data provider. They give you have a 1, 2, 3, 4, or 5-star mutual fund. If you want to get a rating from Morningstar, you have to give them your individual positions. You can do this with a lag. But so what we have is a data set from Morningstar of every single fund that they give a rating to. We know every single security at the CUSIP level that's owned by every mutual fund covered by Morningstar. And so this data set is going to cover all American domiciled funds, or nearly the universe since 1995, and the rest of the world since around 2003. So I'm more than happy to go into the details of the data construction. Let me just highlight a few things that I think are essential to understand some terms in the talk. So first, if I'm going to be referring to a country as a source of investment, it means that Morningstar essentially covers the universe of mutual funds in that company, in that country. Some countries, like Japan, Morningstar does not have comprehensive data for, so unfortunately you will not hear me talking about Japan today. Now, when I say an investor from Canada or from any source, what I'm really referring to is where the mutual fund is domiciled. And so I'm going to be saying the mutual fund domicile is the nationality of the investors who own it. Now, across many countries, there are laws and regulations that essentially prohibit foreign investors from directly owning mutual funds. And in addition, there's often tax optimization reasons why foreign investors would not want to own these funds. So that's an assumption we're quite comfortable with, but I wanted to flag it. Now, where would that be a bad assumption? Say, individual European Euro area countries, where I can't draw a distinction between whether or not you buy a fund domiciled in Luxembourg or Germany. And so we're going to have to aggregate the Euro area to a single country. Now, when I say that you're investing in a particular country, say Great Britain, what I'm really meaning is that you've bought a bond issued by a firm whose ultimate parent is domiciled in Great Britain. So we're going to be doing all of our analysis today at the nationality of the ultimate parent. So with that, let me jump into the results. So the first thing I want to show you is the currency composition of investment portfolios when investors from Australia, Canada, Switzerland, Denmark, the Euro area, Great Britain, Norway, New Zealand, and Sweden buy the debt, the corporate debt of firms that are based in their own home country. So let's look at Canada. The fact that that red line is around 0.95 means that when Canadian households buy the corporate debt issued by Canadian firms, 95% of that debt is denominated in Canadian dollars. So across the board, when investors from developed countries invest domestically, they're going to be lending to their own firms in the local currency. This is probably what you would expect. Now, the second set of bars, the blue boxes, are going to show you what share of foreign investment in the corporate bonds based in each of these countries are actually going to be in that country's currency. So now let's look at Canada again. The fact that that blue box is under 10% means that when foreign investors buy the corporate debt of Canadian firms, less than 10% of it is going to be denominated in Canadian dollars. And so what you see is that even among these major developed countries, when their firms attract foreign investment through debt markets, they overwhelmingly do so in a currency that's not their own. Now, there's one important country that's not in this graph yet, and that's the United States. When foreign investors buy the debt issued by American firms, roughly 75% of that is going to be denominated in the US dollar. And so this is the first sense in which the US is different, in that overwhelmingly, American firms, when they borrow from abroad, are doing so in the US dollar. Now let's look at the currency composition of external portfolios from the perspective of each investing country. So what this is saying, when each of these countries invest abroad, so again, let's look at Canada here. When Canadian mutual funds invest outside of Canada, what share of their debt is denominated in US dollars in red or the domestic currency Canadian dollars? What you see is overwhelmingly, when investors invest abroad, they're either buying the US dollar or their own domestic currency rather than lending in the recipient country's currency or a third currency. What makes this pattern, and particularly the importance of the dollar, even stronger, is that in this picture, I've excluded any investment in debt issued by the United States. So if we were to look at investment, if we were to include the investment in the US here, the share going in dollars would increase dramatically. Now, you needed the microdata, in particular the Morningstar data, to be able to construct this comparison of domestic and foreign investment. However, nothing I've shown you so far is saying we've essentially held all else equal. There could be compositional effects. And what I want to turn to now is to try to convince you that that's not what's actually driving the results. And so we're going to use the microdata to really hope to zoom in on the importance of currency. And so what we're going to do that is we're going to run security level regressions to examine the differential tendency of investors to buy the debt of a firm, the same firm, depending on whether it's in the investor's own currency or any other currency. So the regression we run, the left-hand side variable, we're going to run this regression once for every single investor country, is going to define the share of a given security that is owned by investors from a given country. So if the security is, say, a bond issued by Apple that matures in 2020, and Canadian investors own it, 10% of it, the left-hand side would be 0.1. The key coefficient that we're trying to identify is this beta on the dummy for whether or not the security is issued in the investor's home currency. So from the perspective of Canada, that dummy beta will be 1 if and only if the security is issued in Canadian dollars. Now, what does the microdata allow us to do? We're going to run this regression with a firm fixed effect. So we're only going to identify the differential tendency of investors to buy a security denominated in their own currency, relative to the tendency to buy the bond of the same firm in a different currency. We can also include some controls for, say, maturity and coupon. And so what do we find? We find overwhelming evidence that investors are tilting towards their own currency. So let's again look at Canada. What this coefficient is saying is that Canada owns roughly 93% more of a given security if it's denominated in Canadian dollars. Now, Canada is a small open economy that will account for roughly 1% of global portfolios. So this is saying that Canada will usually own 1% of a security, but it'll own closer to 94% of a security if it's denominated in Canadian dollars. And we see similar, kind of huge point estimates on this effect for home currency bias for our other large developed economies. Now, we run robustness on this particular result across a wide range of subsets. We restrict only to multi-currency issuers. We restrict to foreign firms. We restrict to the international issuance of foreign firms. We do it separately for financial firms, non-financial firms, foreign financial firms, foreign non-financial firms. We include structured finance, sovereign nationals, and local sovereigns to the world of corporate bonds. We also do it for all bonds, and we're able to separately control for the residency in which a security is issued. And across all of these specifications, the predictive power of currency is maintained. Now, the next question to ask is how much, basically, is the currency denomination of an asset, how strongly does that predict that relative to what the literature has shown is the best predictor of international portfolios, which is where a security, the nationality of the security issuing that issued the bond. So this is the kind of classic home bias regression. So now we're going to include a dummy for whether or not the security was issued by a firm from your home country. So this is Canadian firms for Canada. We'll include the same dummy as before for whether or not it's been issued in your currency, and then we'll horse race the two, including a home country dummy and a home currency dummy. Importantly, for this regression, we have to get rid of the firm fixed effects because the nationality of a company does not vary within the firm. I do want to flag a very nice related paper by Berger, Warnock, and Warnock that look at this at the aggregate level. And so what do we find? This is the regression that is trying to predict the share of a security owned on a dummy for whether or not the firm issuing it is based in the investor's country. For Canada, this is saying that Canadian investors will own 49% more of a security if it's issued by Canadian firms. We see similar magnitudes for the other developed countries, and R-squareds between roughly 13% and 50%. What happens if we run the same regression, but we only include a dummy for whether the security is in your currency? We see the point estimates roughly double, and the R-squareds increase commensurately. So the explanatory power of currency appears to be quite a bit stronger. What happens if we include them jointly? What you see is that the coefficient on country is strongly attenuated towards 0. The coefficient on currency is slightly attenuated, but much closer to where it was. And importantly, you see the marginal change in the R-squared between just knowing the country and knowing the country and currency is tiny. And so essentially, once you know the currency in which a security was issued, knowing the country that issued it gives you very little additional information. So now, in the next part of the talk, I want to turn to how this can affect which firms are actually receiving capital from foreign investors. And so in this figure, what I do is just summarize the data on the x-axis by plotting the share of each firm's debt that's in a foreign currency, and on the y-axis, the share of each firm's debt that's owned by foreigners. Each bubble represents a particular firm based in Canada, the Euro area, Great Britain, and the United States. And so what you see is there's a very strong upward sloping linear relationship. If you borrow more in foreign currency, you're basically going to be in equilibrium receiving more investment from foreigners, roughly 1-to-1. A few things to flag. For all of these countries, you actually see a large mass of firms that have no debt in foreign currency. And one difference to see is that for the Euro area, you'll see a lot of firms only borrowing in euros. That's that That's that mass of firms around 0. They're going to be getting very little debt, very little of their financing from foreign investors. For American firms, you'll see even more firms borrowing only in the local currency, but by contrast, the intercept is going to be significantly positive because American firms that are borrowing in dollars still continue to get a lot of their financing from foreign investors. Now, this sorts all of these firms by the amount of debt they have issued on the x-axis, and on the y-axis, it plots the number of currencies in which they have borrowed. And so what you see is that the firms that borrow the most, that are the largest firms, are going to tend to borrow in the most currencies. But for most firms, what you'll see is that they're going to be borrowing only in a single currency. And so we think of this as evidence that there's selection into borrowing in foreign currency, consistent with the idea that there's a fixed cost in issuing in foreign currency. So I don't have time to go through the model at all now. I want to just give you a sense of kind of how we think through this story. Essentially, we think of so there's plenty of reasons to think that if a firm has, say, foreign operations or foreign revenue, they might want to borrow in foreign currency in order to match those two. But we think that that certainly could be going on as well. But what we want to highlight is there's kind of another reason to be borrowing in foreign currency, which is if investors are largely segmented by which currency they buy assets in, one reason you want to issue in a foreign currency is to tap a different pool of investors. So in some sense, this could give you a reason why you would want to borrow in a foreign currency, swap it back to your own, and so you're essentially not changing the risk profile of your debt. But by issuing debt in foreign currency, you're able to tap different investor bases. And so what you'll see is if there's a friction in borrowing in foreign currency, it'll be the larger firms that tend to do this. And so they're going to be the ones that select into borrowing in foreign currency, but smaller firms will not. What makes you the international currency? There's a large pool of investors out there who desire to buy your debt. And so what that means is that firms that borrow only in your local currency, if you're the international currency issuer, will continue to attract more foreign financing than other firms, and local currency only firms will constitute a larger share of borrowing. And so this is exactly what we see in the data. And so in particular, here we can sort firms by the share of, this is for Canada. In red, it's the share that each of these firms accounts for in Canada's investment portfolio in itself. So that largest firm would be 17% of Canada's investment in itself. The blue diamonds are the share of foreign allocation in Canada accounted for by the same firm. And so when you look at all firms, you roughly see that foreign firms are clustered, the foreign weights are clustered around the domestic weights. The right panel is basically eliminating all the dots and diamonds of firms that have issued any debt whatsoever in foreign currency and looking only at what share of Canada's investment portfolio in itself local currency only firms are accounted for. That's the red dots versus the foreign portfolio in Canada. And the key finding here is that if you borrow only in Canadian dollars, you can account for a large fraction of Canada's investment in itself, but you'll be largely absent from foreign investment in Canada. Now, we can make this exact same picture for the Euro area and Great Britain for firms that only borrow in euros and British pounds respectively. And what we'll see, for the Euro area, the Euro-only firms will get a little bit more weight in the foreign portfolio than for Canada, but they're going to be dramatically underweight the Euro area's share in itself, similarly for Great Britain. By contrast, when you make the same figure for the United States and you look at the share of investment going to dollar-only firms, the domestic and foreign allocation to these firms looks very, very similar. So this is the sense in that even though these American firms are not catering towards foreign investors by borrowing in foreign currency, they're attracting foreign capital in roughly the same proportion as domestic capital. Now, you can summarize this by basically summing up the red dots, the local currency only firms share in domestic portfolios, and those blue diamonds, the share that local currency only firms account for in foreign portfolios, and see how different the United States is across is different than other countries. What you'll see here is that roughly local currency only firms will attract roughly the same proportion of the share in the United States as in the domestic portfolio, but the fact that these blue bars are so far below the red ones means that local currency only firms are significantly underweight foreign portfolios in every other country, even though these firms do attract a large share of domestic financing. Now, you might think that there's something about local currency only firms that makes them different, and so maybe this isn't about currency. One way we try to get at that is saying if there's something that makes a firm unappealing to foreign investors, well, then we would think that that would be something that affects your desire to buy their equity. And so we run a placebo. of what's the weight that goes to the equity of local currency-only firms in the domestic and foreign portfolio, and we see no significant difference across countries. So that's another example of why we're confident that we are actually talking about currency. Now, in the last minute, what I want to show you is how quickly this can all change over time. And so in particular, this is just the raw time series in our data of the share of cross-border bond trade that's denominated in dollars and euros. And what you see is this dramatic shift in the share of cross-border investment that's going into the euros versus the dollar. And so particularly since the global financial crisis and the European sovereign debt crisis, you've seen this large increase in cross-border use of the dollar. Now, this is the raw data, but what we can also do is basically control for valuation effects, as well as entry and exit in the data, and this is something that's robust across samples. It holds across a lot of subsets, and importantly, it also holds when we look at the change from 2005 to 2016. You see this large shift to the dollar relative to euros, even when you exclude all investment coming to or from the euro area or the United States. So with that, I want to conclude. In this paper, we brought to bear a new data set to examine global capital flows at the micro level, and we've used that to hopefully convince you of the striking importance of currency in portfolio determination. We think that this leads to a different take on home bias, and it highlights the importance of who's the issuer of the international currency. So thank you very much.